You're watching ASOTUCon 2024, presented in collaboration with Reynolds and Garber.
Gentlemen, take a seat, take a seat. It's that point where we stand up. And if you stand up, you will feel better. That's my only value proposition for you. Deep breath, all right, great. Look at someone next, no, I'm not gonna do any of that stuff. Thank you for being here. Have a seat. We have a really a great conversation, and I feel like this is the conversation that is least likely had in public. Because you, by nature of M&A, there's a level of confidentiality, right? A level of thoughts and feelings that dealer principals may have that go uncommunicated unless there's an outlet. So I think we can serve everybody well by bringing them information. I think this is the first time we've had 3 firms represented at once. We were hoping it didn't turn into the Anchorman scene, right, where the different news crews come in. We almost played that clip just as a joke. But thank you so much for being here. Thank you for sharing your insights. We're going to look at slides that you've all prepared so we can look at some states of the market. I know that you all and your firms are studying the market, active in the market, and I think the best output of this, and it's not just the live audience but the recorded audience too, that we can give them a feel for who you are, a feel for what the market's doing, and hopefully move people toward better decisions in their the plans to sell or not sell. And I think the idea of balancing these 3 things that are in the title. How do we balance profitability? How do we balance what my dealership's worth in valuation? How do we balance what do I want my legacy to be? By nature, it's a very personal business that you're in. And so we'll bring a little light to that, get to know you a little bit. I'm going to give you all an opportunity just to introduce yourself and give us a little bit of your background, because in this business as well, I think knowing the person is just as important as knowing that you know what you're talking about. So we're going to start with Gabe, and we're going to come on back.
Yeah, good. Thanks so much for being here. This is our first conference with you all, and this is phenomenal. I know everything is going wonderful. So thanks again, Paul.
Fantastic. Thanks.
So a little bit about myself. So I've been in auto retail M&A for almost 20 years, believe it or not. I started as an intern at Capital Automotive REIT. I was 19 years old. I was a student at University of Virginia. I see Liza over there, who we've seen each other in Charlottesville. And that's really how I got started in the business.
Just hold your mic a little closer.
Yeah, no problem. So that's how I got started in the business, was at Capital Automotive REIT doing M&A transactions on the real estate side. About 6 years ago, I opened up the office on the East Coast for Kerrigan Advisors, where I'm leading and originate deals across the country. So that's my background. I have 2 young children and love being a dad, and look forward to participating more.
Sounds like a busy life. Brian.
Hey, Paul. Thanks a lot. Yeah, I'm blown away by this, and really honored to be here. But I've been in the business a little over 35 years, mainly with dealer groups, both large public and private groups. Done a lot of M&A transactions over the years, and joined Presidio Group about 2 years ago. And some old friends kind of pulled me in, and so I'm a fresh face for them that may bring a little bit more dealership operational savvy to our discussions and research and what we bring to deals.
Very nice, very nice.
And my name is Garber. I'm Vice President with Haig Partners. This is actually my 3rd ASOTUCon. I went to the first one, and to see the growth of this conference has been amazing, and I finally get to be a part of it, which is a pleasure. I've been with Haig Partners about coming up on 6 years now. I've started assisting on transactions for the last 5 years, and now I'm beginning to originate transactions myself and still helping other managing directors on the team on the transactions they're working on.
So thank you very much again. Let's just kick this off, and then Nathan, we're going to put the first slide up in just a moment. And also, so you know, there is Q&A on the app. If your name does come up on the screen, I will not read it. This will be anonymous Q&A. Here is what I want to start with. The market is certainly different than it was, and just very similar to inventory situation, EV situation. Our mindset sometimes doesn't catch up as fast as what it just was 12 months, 24 months, certainly 36 months ago it was different. So with the changing of the market so rapidly, what would you say is the mindset that dealers should be approaching even an M&A thought with? Like, what's the overarching principle? We'll start, and we'll go down on this one, then we'll throw a slide up, and we'll start to jam on those.
So in terms of M&A, it's really where they are in their career. You've got a lot of dealers that in today's day and age that are at retirement age, and the business has been relatively, I mean, it's always changing, but we've got some significant changes ahead of us. We had a lot of profitability over the last 3-4 years since the pandemic. And, you know, the business is back to normal. You got to work hard and you got to get back in the seat. And, you know, some of those dealers we're seeing either go, we've made a ton of money, we've built these massive businesses, and now is a good time for them to exit. Now, if you still have a 5, 8, 10-year runway, there's nothing else you can invest your money in that's going to make more money than a car dealership. So, I mean, you know, they're going to sit down in the driver's seat and keep going and roll with the changes coming.
Sounds good. Brian, what's your thought on that? What's the mindset?
Yeah, I think it always gets to earnings. You know, so at the end of the day, you've got to really manage your business, and you know, if you miss your window, you know, really, buyers today are looking at the sustainability of earnings. A lot of them are expecting 2019. We might be seeing that in the numbers. Who knows where we'll end up landing? You know, we've been through margin compression before. Yeah. Dealers, the really good dealers, are already on top of expenses that they can control. The challenge has really been rates at a time that inventory supply is coming back.
Right.
Not to mention EVs.
Not to mention EVs. How about those things? It'll be interesting to see how dealers who are good at EV sales fare 4 years from now in valuation. Like, is it going to help? Is it going to hurt? I don't know. Gabe, what is your thought on the overarching mindset that you think dealers should be adopting as they approach even a thought about, you know, what the M&A plan might be?
I think that the fundamentals that businesses are sold on expected future earnings has not changed. So when you look at the last few years, you know, 2019, most people thought that the following year would look the same. So they were using the current earnings to base the valuation of their business on. The pandemic totally changed everything. However, it was common knowledge that this was temporary. So I think the big misconception was that, oh, the businesses were valued and sold on pandemic earnings. They really weren't. Their buyers were factoring in where will earnings normalize to. I think the difference between today and 2019 or even a year ago is that most feel that we are normalizing or we're normalized and we're going to be constant. The fundamental is that the business is still going to be valued on the expected future earnings. And I think for folks that are considering that conversation without speaking to an expert who sees really the offers that come in once you put an opportunity out into the market, you're really just guessing.
You're guessing, right? Because you all see the offers that come in. You're like, actually, this is how people are making their adjustments, factoring in the variables, and putting real-world prices across the table.
That's right. And I'd also remind that there's ultimately one person who buys the group or the dealership. So just because 6 people had an offer in a certain range, the market value is what it trades for.
Right.
So even folks that are buyers will say, well, no, that's not the way it works. It's like, well, we just sold it for this dollar amount. That's the market.
Yeah.
It's actually funny. I think it was like 2 years ago, we trademarked the term most motivated buyer. And that's what that one buyer is that comes in and sets the market price for that store.
Right. I think car dealers understand that.
Yeah.
Like, I mean, you think about with the inventory shortage, we had a lot of motivated buyers that were doing things that had a specific value, but then that did set the market for those vehicles, that segment, et cetera. There's one thing that came up in our prep calls, and it stuck with me, and it's one of the fundamental differences between now and back 2019, early 2020, is that we're not seeing anyone in like distressed situations, right? And would you agree with that? I think we talked about that. Like the distressed situations, it's like there's a little bit more measured pace that's going on.
Yeah, I mean, it is important for buyers to realize, and especially 90-something% of the buyers out there are already dealers. And they understand in this world, there's no fire sales. you're not going to get a discounted cheap store for a competitive store in a growth market. The vast majority of stores are still extremely healthy right now. There's a few one-offs, I'm sure, but in general, I mean, stores are profitable. They're still way more profitable than they were in 2019. And the lowball cheap deals they're just not there.
Is that what you're seeing as well?
Yeah, the business is just getting tougher to make the same or a little less. And that's what everyone's really feeling. But everybody's also, luckily sitting on a lot of cash that they're trying to do stuff with or get a maximum return.
Have you noticed the velocity of deals? Like the time from, consideration to transaction speeding up because there's more cash in the market?
So I want to touch back on the previous
Please do.
item, which was the conversation regarding, how are buyers? Sorry, are there distressed buyers?
Yes.
So I think we're biased. We are hired by legacy families who've been around for generations who are looking to monetize that legacy. So I think that what we're seeing, no, we're not seeing any, distressed sellers. However, I do think that if you talk to some of the bankers out there, the folks that were using a large amount of leverage the last few years to acquire stores, I think that's where you might see some opportunities. So I think there might be groups that have sold in the last couple of years with a buyer using a lot of leverage that you might see again.
Got it. Nathan, let's bring the first slide up. I'm not sure what order they're going to be coming up in. And each of you, okay, so here we go. We're going to look back here for a second or over there. So this is the Kerrigan slide, so you get to go first, Gabe. If you could explain the slide, and oh, it's right there too.
I got it.
It's kind of a weird spot for the monitor. I'm going to look this way. But Ged, why don't you talk us through this and tell us the insight?
Yeah, so, we were asked to put together one slide with some data, which is difficult for us because our annual report has 50 pages. But
I know, I was like, you have to pick one.
We chose
minutes.
one, and I think that what people in our industry sometimes aren't aware of is what's going on in the broader M&A market outside of automotive retail. And this depicts that broader M&A is down 30% in volume versus, our industry has seen an increase. So, there's several factors as to why we're seeing this. So we are the anomaly. We are in a phenomenal business with some good fundamentals. However, there's some unique aspects of our business, and I look around the room, most dealers here are with privately owned dealer groups, right? So those private groups, their valuations aren't sensitive to the public market. So interest rates go up, the public dealer groups really see a decline in valuation. We're not seeing that. So most of the buyers in the activity are privately owned dealer groups. So that's one important thing. They're not as impacted by the fluctuations in the greater market. Secondly, and if you look at the bar chart on the right, our estimation is that dealers have amassed nearly a $250 billion in the last 3 years. And that's largely sitting on dealers' balance sheets. And that's what's really driving the growth. So I had mentioned previously distressed sellers, very rare. There will be few. And the reason being is that most buyers are not using huge amounts of debt. And if you ask the bankers in the room, they'll tell you that debt to equity ratios are still significantly lower than they were pre-pandemic. So that's what's driving this growth.
So on the line graph, we're seeing, is that negative 30%? Is that
volume of transactions? So
general M&A?
General M&A is way down.
Yeah.
Because the fundamentals, high interest rates, high borrowing costs, these are
right. And our variables are privately held companies with a lot of cash.
Exactly.
It's a good time to be a dealer, isn't it? Any other thoughts on this slide, gentlemen, while we're talking about this?
I mean, I just want to second that. I mean, even some of the largest transactions we've completed, we've seen majority of the transaction done in cash, which is mind-blowing when you start looking at the numbers and the size of these deals. But the chart shows it there. They made a ton of money, and it's time to put the money to work. So they are.
Yeah, and a lot of people are leaning into the industry.
Yeah, and we see a lot of dealers and large groups trying to diversify and still support automotive by investing in tech companies that are supporting auto retail.
Yeah, there's been I think it's a very encouraging move where we start to see auto dealers get into ancillary business verticals, specifically in tech, but also I've seen a variety of things. Because when that happens, I think the industry just gets stronger because you have empathetic, understanding owners and investors that understand what it looks like on the front line, what it looks like in the end goal. So that's an exciting thing for me to see. Let's see the next slide, please. All right, it's the Presidio slide. Brian, what do you got?
Yeah, so this is a merged data graph, so to speak, of two different slides from our quarterly reports. It's kind of running through Q1 of this year using our Presidio NCM average dealership metrics. And what we wanted to show here is, how the period over period change in earnings relative to the change in new PVRs and pre-owned PVRs. And, the point here is there's other things creating this earnings adjustment that's racing quicker down than the PVRs are actually racing. And you can also see that from a pre-owned perspective, we're within $100 on a PVR basis relative to 2019 already. So the point here is there's some major uncontrollable things that are going on.
Oh, you mean you're not able to just drag this 3 quarters forward and show us what that number is?
Yeah, well,
It's trending.
Well, at the end of the day, it's still trending 63% higher than 19 if you just straight line it for 1 quarter, which, it's not how our business works, but on a straight line basis, you would still earn 63% more than 19. That's still a good story. Shows the business is extremely resilient because we're dealing with rates versus March of last year that are about 3 times higher.
So would you call it a seller's market still?
Yeah, we see it as a seller's market. Yeah.
Also?
Yeah, I would say one comment on this slide. There are definitely haves and have-nots in automotive retail, and I'm talking specifically with franchises. So top luxury or top import in high growth markets, are faring much, much better. These numbers are obviously average of the whole industry. And I would say that absolutely there are more buyers than sellers, which inherently would tell me it's still a seller's market. Yes, but if you're in the Southeast with a Toyota store, it is a different calculation than if you're in, the Midwest with a domestic brand in an over-dealered market.
Right.
Yeah, I mean, definitely to Gabe's point, that's how we see it. Brands and geography matter more now than ever.
And I also want to touch on that, and I think Gabe did a little bit earlier too, is we are seeing this normalization and decline in earnings, but in correlation to value, I think your chart here says about 32% down in Q1. We're not seeing values are down 32%. And that's because values did not increase 3-4x.
Because the market was making its own adjustments,
Exactly.
factoring into Gabe's point
Dealers,
already.
Yeah, dealers are always projecting to the future. So that buffer from the peak, in our opinion, is more around 12 to 14% from the peak in terms of value.
Were you going to say something? Add something?
Yeah, I was just going to say, any solid buyer right now, and for the last few years, has been trying to assess sustainable future earnings.
Yeah.
Looking at historical, but we look at it relative to revenue, So at the end of the day, we like to look at what we expect a store to make based on revenue.
Although the market has been volatile, what you said initially, you said the principles have not changed, and they still factor. Maybe there's some adjustments based on factors, but the principles are the same. It's still rational, right? When you talk about M&A, I think there's just generally the scale of the decision, right? Makes everyone slow down, be a little more rational. Let's bring the third slide up if we could.
So this is an interesting data point that we've kind of noticed over the last few years. This chart here is showing the change in market share from the different franchises from 2019 to Q1 2024. And it actually highly correlates with buyer demand in these brands. There's some outliers in there, like obviously you see Honda is over on the red side, but that brand's still doing fantastic. Buyer demand is is great. And
Brian Benstock agrees with you.
yeah, and of course, and he's a great example of it. But if you look at the far ends of the spectrum, let's start on the positive side. Hyundai, Genesis, Kia, Mazda, Toyota, BMW. Those are the brands that have gained, in a percentage basis, the most value in terms of a multiple. Not only have their earnings increased, but the multiple has increased quite significantly over the last 3 to 4 years. I mean, Hyundai and Kia really used to be compared to Nissan.
Absolutely.
In
2014,
2015. Now those brands are touching up near where Honda and Toyota are.
Yeah, knocking on Toyota's door.
It's fantastic to see. And then on the other end of the spectrum, you do have to talk about it, is Nissan and CDJR. They have lost a significant amount of market share since 2019. And those brands are struggling now. And this is just today's snapshot. But it does not mean that those brands this is not the best time to possibly buy those brands.
Who's buying Nissan, CDJR, Ford stores? What type of buyer?
I would say it's a buyer that is foreseeing into the future. They know that, at least on the domestic side, these are brands that are not going away. Stellantis, Ford, GM, these brands that are legacy brands in the United States. And CDJR has cycles. We're in a down cycle right now. So if you are buying a store with depressed earnings at a lower multiple, so it's like,
And you have some patience.
yeah, if
right?
any of you guys invest in the stock market, it's buying the dip.
Yeah.
And you're waiting until it comes back and starts retracting market share, which it may do faster than any other brand.
Any other thoughts on this? No.
Yeah, I have a couple thoughts on this chart, and I'll kind of piggyback on the Chrysler and Nissan comments. What we're seeing is the strategic, very large dealers are looking at divesting of those brands, and certainly it provides an opportunity to some, up and coming
divesting?
Divesting,
Oh, yes,
yeah. And it provides an opportunity to some, up and coming dealers, new dealers. Alternatively, if that's a tuck-in store in your market that's owned by a larger group that doesn't have a presence, you can justify that. One other thing too on Mazda. So no one touched on Mazda. Mazda's the third on the left chart, I believe. And
They're on my heat seeker list. Like Mazda is definitely on the upswing.
yeah, I would say, and we just upgraded Mazda in our Blue Sky report. I can see a time in the near future where Mazda's multiples are higher than that of Nissan's, despite having lower UIO count, lower sales throughput. It's because, again, it's expected future earnings. The positive outlook on that brand will outweigh some of those negatives of it.
What's Mazda doing right now? Or are you just
I mean, it's certainly is product,
right?
Affordability. So to me, product is still, look at Honda, right? So Honda is on that side of the chart because they made some bad decisions during the pandemic, but now they're making up for it, and they're making up for it through product.
Yeah, and if you watch the historical chart, you know what's going to happen with Honda.
Yes.
Like, you don't bet against them.
Well, and to touch on Mazda, Mazda US actually came to our offices and started explaining to us the value in their stores. And it's correlating a lot right now to their rooftop count. Mazda just required all their dealers throughout the US to do with this new image program. It reduced the rooftop count significantly. Don't quote me exactly.
What was the cost on? Do you know the average cost on the image program?
No, I do not have it off the top of my head. I'm gonna have
Does anybody know the answer to that?
to call my analyst back in the office.
Okay. Might be a Mazda dealer that
But
knows.
anyway,
Former Mazda dealer maybe that knows too.
reducing that rooftop count is extremely strategic. If you actually look at the stores that have the franchises with the highest throughput, it's a lot based on rooftop count. I mean, the domestics, that's the reason that it's so hard to pump volume out of those stores. Now Mazda's reduced rooftop count, throughput will increase. The future of that brand's great.
Brian, any comments?
Yeah, I'm just thinking you need to talk to Patrick Abad from Beaver Toyota.
Yeah.
It's
And
my
that's going to
neighbor-
be an awesome Mazda store.
Yeah.
I was on site
Yeah,
a few weeks ago.
Impressive.
Underground
it's-
parking garages always get me excited.
I was talking to him yesterday about it. So seeing it up
Yeah,
in person.
we're going to
is
be
just
talking about
overwhelming.
Mazda a lot more in the next few years for sure. Thank you for bringing the slides. Thank you for the insights. I think every little bit of information and insight helps. I know when all of you release reports, they have 50 pages of insight. So a lot of the time, unless you're really like excited about like going through 50 pages, I think the drip feed is very helpful. Let's talk about the human side of the business for a moment. And also, just to remind you, if you do have questions, they'll pop up on the monitor here and we can answer them. Human side of the business, I know people sell stores for a lot of different reasons. Let's talk about the sell side first. What are some of the common threads that you're seeing? Now, I know there are a lot of reasons, but what ones are popping up more than others? We'll start with Gabe.
Yeah, I'll say, it's a very deep emotional, process to sell a business that has had your name on the side of the building for generations. Many of our clients, they were born with the name already on the side of the building, and now they're the one in the seat. So it's not an easy decision to make, and we're used to dealing with those families. I will say that, and I'll share this because I always find it fascinating, is at the closing weekend, it's usually me and the dealer principal, maybe the right-hand financial person. What are they talking about?
Yes, that's what I want to know.
And I have many examples of this, they're saying, hey, Joe over there, I hired Joe, I met him at the grocery store, I thought he was phenomenal, gave him an opportunity, now he's my general sales manager, he just bought a $1 million house, and I'm just so proud that the business provided these opportunities. So that is a common thread. I've heard stories that sometimes the dealer has never even shared. I was there and with a dealer down in Florida, and he said, he shared a story that, he found out this guy was living out of his car. And he said, no, we're not going to do this. Come on, we're going to go. He furnished his apartment, he got him started, and 20 years later, he's still working for them. So that is what the deal, that's the legacy. And you had it in our kickoff call. That's the legacy discussion, is how can you live with, that you're leaving and it's a new era, but you've already established this legacy that's going to continue whether you're stepping into that store or not.
Oh, that's great. Brian?
Yeah, that being said, their name's on the building. So if that name carries forward with the new buyer, even beyond the deal, it matters. It
So
cares.
you're saying the
It
sentiment
cares.
is they'd rather have the name carry forward with a new buyer?
If that is
More
how
times
it works,
than
if
not.
that's how it works out.
Yep.
Some people may say, hey, I
Of
want to
course.
keep my name as part of the deal. But,
Right.
but at the end of the day, because their name is on the building, it goes beyond the transaction.
Mm-hmm.
And to Gabe's point, a lot of what we see is they want to be very selective about who they choose to allow to buy that store.
Because legacy is a high consideration, is what you're saying.
And because they care about their culture, their people, and they want their people taken care of.
Yeah.
Yeah, and it's speaking of the legacy and also just the dealer mindset, speaking of those conversations you have at the closing table, it's never, I don't think I've ever heard, I'm just going to go to my beach house and sip some coffee now. It is, I'm starting a massive nonprofit organization to help all the people in my community. It's, one dealer started an animal veterinary clinic. Another one right now is opening the largest pickleball facility in Charlotte. It's they never stop. They think they're done, but they never stop.
Yeah, their spouses don't think they're done,
Exactly.
right? They're not fooling anybody.
Exactly.
We've seen that over and over again. Oh, we have a question. Thank you. You're just going to be my monitor guy. When developing an acquisition strategy, what are some key areas that should be looked at? So, let's go. We'll start with Derek. And we'll go down. What are the key areas? Or why don't you give us a key area so you don't say the top three and then we don't have anything else to talk about.
Well, it's real. It comes down to brand and region. It's very important to communicate that to everyone you can in the industry. Your CPAs, your lawyers, your investment advisors, your M&A advisors. Those two things is what is extremely important because, like what Paul was saying earlier, this is a very private, confidential process. And if people do not know what you are looking for, you will not be called for these opportunities.
Yeah, I would agree. That's the critical piece right there is
Where?
knowing where and what you're looking for, and then having a plan and a purpose of how it works not just today, but in the future, and how you can, because really it gets into scalability. How easy is it for you to operate, manage, support? So there's all those factors as well. It depends on the structure that you already have in your organization.
Yeah.
Whether or not you're going to run it well. So there are a lot of things to be thinking about, because once you pay the money, you've got a business to operate, and you're looking for return.
Yeah.
Yeah, I would say, does the scale of acquiring another store or group add scale to your bottom line? So are you building economies of scale? And usually it's, we want to stay in a certain region, or we want a high throughput store, because you look at that net to sales number and they're higher, whether it's high throughput or in a region where you can have shared resources.
Well, listen, I know the three of you are easy to find on LinkedIn. We have them all linked up in the app. So if you have further questions or want to develop a conversation, please reach out. Thank you so much. Can we hear it for these three gentlemen for sharing their insights with us? Thank you to you and your firms for joining us. Hope you have a great time for the rest of the day.